I want to welcome back Kirian von Hest, who also goes by Deso. He has a rabid fan base on the internet because he's made some good calls and people have done very well following his advice. So welcome back, Deso.
Well, welcome to be back.
Yeah, so last video we talked about the dismal economic landscape and why the Fed is going to have to debase the dollar, trying to plug holes in the dam with their fingers to prevent economic collapse. And we also talked about how hard assets might be kind of a way out to protect your wealth in that environment. But in this video, I kind of wanted to talk about like which hard assets, which trading strategies excite you and really can maximize returns in this dystopian future that we're talking about.
First off, silver and gold. I will be remiss to talk about silver, even though I know that's basically being talked about a lot now, with good reason. We're not going to be spending a lot of time on it, but I still wanted to mention it because of stuff that's been happening today. Basically, we've had multiple mints around the world more or less default on their obligations. They're not calling it a default because they don't want to, but it definitely is. It's in their prospectus that they have allocated silver and unallocated silver. And according to their obligations, they should be able to deliver the unallocated silver within 10 days in any shape or form, and they just can't. Now, the difference between those two is allocated silver is silver they have and is already set for production into bars and coins and whatnot. But minting machines have an operating speed as well, so it hasn't been converted yet. Or people have bought the gold at the mint and the mint just stores it for them, so it's allocated to them. Unallocated gold is gold they essentially lease or lend from central banks or other institutions. And once someone requests delivery, they can in turn request delivery and they'll get it. Usually. But the Perth Mint went first, and we started getting reports in of people not being able to get their unallocated silver. And upon pressing, it was revealed that it might take up to a year in some cases. So that is quite concerning, but it basically means that the Wall Street silver squeeze is working. And people never understood that we never needed to go straight for the 1,000-ounce industrial bars. But it took a while to understand, but Wall Street silver got it, that the coins need to be made out of something. And the mints all use these 1,000-ounce industry bars because, well, they're the standard of industry. Everyone uses these bars. So if we just keep buying at the mints, eventually they'll just increase production capacity because that's how capitalism works. And there will just be more drainage at the bars. Now, actually, more reports came out that the Sunshine Mint has shut down until like September because of COVID or maintenance or whatever. And I think we're now up to 3 out of 6 mints that have gone down. We also have reports from the American Mint that they are unable to meet demand because of lack of metal. So the silver squeeze is real and it's going to happen real soon. And it doesn't matter that there will still be 1,000-ounce bars available from the right guy at the right price. It matters that at some point in the very near future, we're just going to be able to walk through a shopping street and ask anyone, do you have physical silver? Well, you're too late because you can't get any more. And if they say, well, why not? There's plenty of silver. Yeah, but can you buy it? Can you afford a 1,000-ounce bar? That's like 26,000 euros or $26,000, something like that. Well, of course they can't. Most people can't. So they have to buy coins, but that's the thing. There are no coins. It doesn't matter if it's because of the silver or because of the minting capacity. It's simply that minting capacity is currently the weakest link in the chain, simply because there's not been that much investment demand over the last decade. So there was no reason to expand minting capacity. So that's the first one to go. and the shops will still be on back order for 6 weeks. And then we just go around telling people, look, if you want to get silver, maybe you can get some in 6 weeks, but who knows how much industrial bars will still be there in 6 weeks. Because obviously, if the mint just gets orders, they still need to find the metal. Like, they still need to allocate more metal, or they need to stop taking orders. If they stop taking orders, the same will apply. You can't get any coins anywhere. So in all cases, the plan is progressing as expected, and pretty soon there will be a consumer shortage of silver. And that consumer shortage is going to lead to an industrial shortage real quickly, because the industrials are not going to wait until their critical metal is all gone. And then whoever still owns physical silver, not SLV, but physical silver, no paper, wins. It's that simple. Everyone who doesn't have it loses.
Yeah, absolutely. And you could even see that right now, because if you do have a silver coin, you could probably sell it on eBay for a premium to where you bought it, right?
Oof. Actually, not too long before we started this interview, I looked on hollandgold.nl to see if there was more supply of silver. There was. They just got in a big shipment. Like, it's not like silver will be completely gone. It's just that demand is overwhelming supply greatly. So whatever trickles in anywhere, just going to be gone within seconds. Think of concert tickets, something like that. So they got in a big shipment. I posted on Wall Street Silver, so it'll be pretty gone. It'll probably be gone by the time this video comes out. But I calculated the premiums. Euro spot silver prices right now closed at 22 euros and 3 cents. The coins, the Maple Leafs and the Philharmonicers, the most popular ones, are 27.80 euros, and that comes down to a premium of 26%.
Wow.
Yeah. And that's now. When I bought my main stash in December of 2019, my premiums were about 18%, and they were already substantial at the time. And I spent an average of 17 euros 77 on my ounces. That's with premium. So to get the 305 ounces that I bought for 5,600 euros, I did average in a little bit. 305 times the current silver price is about 8,000. So I'm already up 2,500, and that is during severe suppression, because the spot price is still not going up that much, even though there's just no physical. So, but that's also explainable because originally I predicted the COMEX would die because of what the banks did, but the bastards again got greedy. They could have collapsed it on New Year's, gone to a week-long banking holiday. It would have been an orderly collapse. But they wanted to drain more. So they've been draining more metal out of the COMEX for months now. And shame that we found out. So now we're collapsing the market from the bottom up. That means the coins are the first to go. Then there's shortage problems at the mints. Then there's probably going to be problems by SLV or one of the smaller ETFs, most likely Silver. That'll be, well, let me just compare it this way. The Perth Mint defaulting, and then the Poland Mint not having any investment silver anymore. Mexican Mint is out. American Mint is out. And more reports of various others. That's basically the two hedge funds at Bear Stearns collapsing in 2008. We are now looking at a Bear Stearns type of event that something big and established, which everyone thinks is safe, is going to fall. And I'm totally guessing here, but I'm just going to think it's one of the smaller silver ETFs that is no longer able to basically find the bars they need if they start getting drained. So that's the one we're waiting for now. And then after that, it's just waiting for a Lehman Brothers. A big fish, or well, not the biggest fish, But a smaller fish that falls over, everyone thinks it's not a problem, and then it turns out to just fail the entire system and the COMEX dies overnight. Something like that.
Yeah. I mean, if the mints are out of supply, then there's clearly a supply shortage, which should put pressure on COMEX. And then coupled with kind of the increased industrial demand for silver, there should be a serious squeeze on the system, I would think.
There is no telling how big this thing will go. Currently, investment demand on silver is like 0.25% of portfolios or even less. Gold is a blip on the radar, and compared to gold, silver is a blip on the radar. It really is that bad.
Yeah.
And it's insanity because silver is one of the most critical, most useful, and most used metals in industry. So it's another example of human folly that we ever let it get this far. And whoever holds actual physical metal is just going to be very wealthy. And it's going to be even worse because gold and silver are still money. They are both actually linked. There's like a 90% correlation throughout the entirety of history in terms of price. So if silver collapses, or well, the silver section of COMEX collapses, the gold section is going to collapse next. And since gold is still money, basically all commodities are priced against gold. And if gold goes through the roof, that means all commodities go through the roof. You're going to get another 2011 commodity bull run, only this time it's not going to be based on the expectations of hyperinflation. It is going to be based on hyperinflation. So Lord only knows where this is going to end up. I only know it's going to end up somewhere bad.
Yeah, I agree with you. But I do agree that I like the physical holding of silver, but then the purchasing of shares in the miners, right? Not like a futures contract, based on the silver price, but the miners.
There's three options here. The first option, and again, if you don't have any physical silver, you need to have some physical silver. Basically because when everything has burned and collapsed, people are not going to care about your gold miner shares. They're not going to care about your ETF shares. They want to hold physical because they need to give it to the farmer to trade it for food. And we are going to such a situation. However, once you have that, there's other options. Once your safety is secured, you can put it, for instance, in PSLV. PSLV is a audited, more trustworthy, closed fund silver, meaning on up days they add, but on down days they don't extract silver from the vault. They are a heck of a lot more trustworthy than SLV. Since the beginning of the year, and especially since the silver squeeze, SLV has lost something like 78 million ounces. There have been constant outflows, especially after Wall Street Silver was created and started pushing everyone away from SLV and towards PSLV. And PSLV has added something like 20 million, 24 million ounces in the meanwhile. So this is already a difference of 100 million, and it will grow because we are continuing to grow, and we are continuing to push this to put audited physical, and a fair silver price first. So in that case, PSLV will do well and SLV will crash. Your third option then is silver miners or gold miners. Like I said, silver and gold are linked. And even though there's a supply deficit in silver, the capital demand pool for gold is much larger. Basically, when everything collapses, everyone who's under a millionaire rushes to silver. Everyone who's over a millionaire runs to gold. Something like that. But that means that since 90% of the wealth is concentrated into like the top 1% or the top 10% of humanity, once they start running, they go to gold. And that means so much wealth is trying to preserve itself in gold that gold is also going to go through the roof. But again, gold will drag silver higher. So it's going to be probably an interplay. You're going to see some crazy shit, that's for sure. But once everything's collapsed, you can still trade gold miners on the market and such. But the important part there is that if you have the opportunity to become really rich by investing some capital you already have now into gold and silver miners, just before the end of hyperinflation, since those two will do well, you want to rotate all your winnings from gold miners and silver miners into oil or into energy or into uranium or into EVs or into tech. Tech is going to do very badly in inflation because it's basically not necessary. People don't like to think about it, but you don't really need to buy a new iPhone every year. If they didn't employ planned obsolescence in the freaking software, which is dragging these things slower and slower and slower, you got to remember, we have supercomputers in our pockets now. Most people don't really need more computing power than we already have. And then people are going to say, well, I don't need a new iPhone this year because first of all, I can't afford it. And second of all, if I have to choose between starving or just having an old iPhone, I think I'll take the old iPhone. Thank you very much. So tech will just drop. But at some point, tech's still going to bottom because there will be a recovery. I don't know when. It's not going to be this year. Not going to be the next one. Not going to be the next one. But maybe in 10 years. Maybe in 20 years. At some point, all good things must come to an end. And in hyperinflation, it's always key to rotate into income-producing assets just before the old currency dies. And you have some sort of insight into the new currency not hyperinflating on its own, because then you're still off to square one.
Yeah.
It's how humans work. They overbuy and then they overproduce.
Yeah, exactly. But so for the silver trade, it just seems like such a incredibly just beautiful trade. If you think 10 years out, oh yeah, you really think it's going to be lower than $26 an ounce? And if it is, imagine the buying opportunity, right? If you can get it for $14 an ounce, it's incredible. Yeah. So I like it, but if we think about the headwinds, any potential headwind, obviously the U.S. government or any government tries to defend their currency, right? They're very protective of it.
They can try.
Will they see silver as a threat to the currency, and is there anything they can do about it?
No, they haven't loved silver since 1860 or something, when the U.S. demonetized it, or whenever that was. It's not been money for a very long time, and the silver crowd doesn't want to hear that, but it's only money because people's perception of it is money. Now, those perceptions will reset once everything starts crashing down and silver starts going up in price when everything else is going down. But right now, it's not money. You can't pay with it anywhere. You can pay in more places with Bitcoin than with silver, simply because the shops see no need. Their currency still works. It's still valuable. They can still pay taxes with it. They can still buy stuff with it in other shops. Sure, prices have gone up, but that's happened before in history, and they've gone down later. So why should anything be a bother now? My inbox is filled with people complaining to me on how their mother, father, or significant other just refuses to see things their way, aka my way, and just wants to keep their money in the bank, even though the people contacting me are begging them to just put it into gold, silver, or anything that keeps value. Just don't keep it in the bank, and they will have none of it. So a lot of people will not adjust to the new normal well. They will be in denial all the way to the end. But the end will come.
Yeah. So you're saying that, if there's hyperinflation and if silver and gold skyrocket, let's say 1,000%, right? Because everyone piles into it, the government will do nothing. They'll just stand back and let it happen.
They don't have a choice. Where are they going to get the silver? I mean, they can outlaw private use of silver, but who's going to enforce that? I mean, it's very simple. There's always a couple of stupid things they do or can do, and it always depends on how stupid the country is, what's going to happen. They can nationalize silver mines. They can just outlaw silver and nationalize silver mines. What's going to happen in hyperinflation is the same thing that happened to the Venezuelan oil industry, is that the government can't pay its workers a living wage because they just don't have any money. So the workers will starve if they work for the government. No one's going to starve and work. So they will just abandon it. And we saw that happen in Venezuela when the currency started to slide. many people in the oil industry just stopped showing up for work because they were too busy securing food. So nationalizing is not an option. But some people will try. Some countries will try. I still say that if the government just straight up bans any transaction in silver, that it doesn't matter because the black market will be so big that you can still spend it anywhere.
Yeah. Yep.
Look, it's simple. You can't track silver. What the fuck are you gonna do? It's anonymous. If nobody reports it, if nobody reports your ass, no one's gonna know.
And it's not on the blockchain. I'm sure the government can't wait for everything to get on the blockchain so it can all be tracked.
I will laugh and laugh and laugh if I ever come to visit America in a desolate future, because I am pretty sure there's going to be surveillance cameras everywhere, and none of them are going to work because the government ran out of money. They had to turn them off because they couldn't afford anyone to look at the screens.
And it seems like it's all going to go hand in hand with kind of like a fascistic rise of government banning information, and they're trying to control it, and it's all going to coincide with trying to protect the currency, I think, right? So that's what you're saying, all these cameras.
It's a natural confluence of circumstances. Many people like to think that what's happening now is happening because of some grand conspiracy. There's no really any grand conspiracy. It's just one faction of the elite trying to grab power over the other faction of the elite. And so far, the Democrats have won.
Yeah.
It's that simple. There is no grand conspiracy between the Bilderberg group or the Council of Foreign Relations. No, you know what that is? That's a club. That's a club for people who are out of touch.
I mean, that bottom line is big business runs politics.
Yeah, money runs the world. That's the main advice that I've been giving my subscribers and followers ever since the whole pandemic started, and ever since I have had a call out since February 2020 that there would be another conflict, global conflict, this time between America and China over Taiwan, simply because of TSMC, the Taiwanese semiconductor manufacturing company, which has currently a monopoly on all ultraviolet lithography production processes in the world. So all your Intels, your AMD, well, not your Intels, but Intel's lagging behind. That's the problem. But your AMDs currently, your smartphone chips, your graphical CPUs or GPUs, all of it's manufactured on that little island off the coast of China with a lot of missiles aimed at it. And that war is going to happen because both America and China need an external enemy. So there you go.
So just moving on, we talked about silver. My next favorite one is uranium. In a nutshell, there are lots of uranium bulls out there. Everyone has a unique perspective. I'm sure you do. In a nutshell, why are you bullish uranium?
Because there's a supply deficit.
Yeah, it's pretty simple, huh?
Well, it's the same stuff as with silver. You're not going to pay with it, but you're still going to use it. You're still going to need it if you want the lights to turn on. It's pretty useful.
Yeah, it's pretty straightforward. Well-documented supply deficit, supply crunch on its way, just like in the past. It's just repeating itself. So, agreed.
Yeah, there's just look. If it's simple and fundamental, then you don't have to look any further than that.
It is interesting though, because unfortunately, you kind of have to give the benefit of the doubt to the politicians to make the right decision, right, and invest in nuclear versus renewables. And I know renewables have failed, but will that stop politicians doing the thing that sounds politically correct? I don't know.
When there's a mob outside of the door because they don't have any electricity, they will. I mean, you saw the rampage that the Texas went through when they didn't have any electricity.
Right.
Well, that's because of a freak weather event, and they can blame that on the freak weather event. But what's going to happen next summer? Because last summer, California already had rolling blackouts. So what's going to happen next summer and the summer after that and the summer after that? At some point, people are going to get sick of it, and they're just going to want baseload power that works. And America's got a choice. Either they can use up their coal reserves, which they have a lot of. America's got like 250 years worth of coal reserves in the ground.
Wow.
And they can either burn that in the atmosphere and add CO2 back, which they all try to save so foolishly, or they can use nuclear power, create Jesus Christ, CO2-free electricity, use that CO2-free electricity, which will be available in abundance if they just apply economy of scale to small modular reactors or small mini reactors, whatever to call it, the SMRs. And if they then use the abundant electricity to generate or pump coal through a chemical reforming process, you can get hydrogen out of it. So the way it works with hydrogen currently, because I know you're also interested in the hydrogen economy, Definitely. It's not green at all. There's two ways to generate it. One way is with electrolysis, which everyone knows. You stick two electrodes in water, you run a current through it. One end gets direct current. One end gets oxygen, the other end gets hydrogen, and you just siphon off the hydrogen. Well, it's a very inefficient process. Takes a ton of energy. And the problem with hydrogen is because it's such a small molecule, you lose about 3% of what you store every, I thought it was day or week or month. It's a ridiculously short period. Like, the problem is that the molecule is just so tiny that it worms its way through every other molecule or structure that we can think of. We'll find a way around that in the future. We'll always do, but currently it's still shit. Now, the way they've been generating hydrogen for industry is very simple. They're using natural gas, which is a fossil fuel, but using a process called steam reformation, you can change natural gas into its component parts, and one of it's hydrogen. Or, well, you can make hydrogen out of it. Naturally, that's not going to last because the natural gas also at some point will run out. But I looked it up, and you can actually do the exact same thing with coal. You could do the same thing with oil, because hydrocarbons are basically what you're dealing with here. So if you can extract the hydro from the hydrocarbons, you're basically left with carbon. Now, I have read about it, and the process still needs industrial improvement because there needs to be a better way to capture the CO2 released with the process and separate it from the hydrogen. But at the same time, there hasn't been a lot of research into this because we're talking about coal reformation instead of the more profitable one, natural gas reformation. But if we're using all the natural gas in our power plants, because we're using natural gas-fired power plants are the least emissive of all the fossil fuel power plants, well, why aren't we using the coal for hydrogen then? I mean, if electrolysis is really so inefficient, if we just use the chemical reformation on coal, if it's slightly more expensive than natural gas and we save the natural gas for power plants, well, we're there. Abundant power and abundant hydrogen. Because we got plenty of coal. And by the time we run out of coal to turn into hydrogen, we'll have developed fusion because of America's massive reserves.
Wow. So when they do create hydrogen out of natural gas, does that emit CO2 into the air? Is that not a green process?
I'm not entirely sure what it emits because I haven't looked that deeply into it. But I do know that it costs water and it costs natural gas. Yeah. Natural gas is a fossil fuel, so I never looked at how much emissions it gives. I just know that from industrial demand, currently the only way to get hydrogen cost effectively, meaning affordably, is via natural gas reformation.
Gotcha. So you still have to pump the natural gas out of the ground, frack, and all that stuff. So
yep.
Yeah, and it's probably pretty expensive, right? Like way too expensive to use hydrogen than most other fuels, right?
That's because hydrocarbons store hydrogen better than pure hydrogen does, because it basically compacts and encloses hydrogen in a cage. You can basically compress hydrogen with carbons. With pure hydrogen, you don't have that. So you basically have to compress it yourself by pumping more and more gas into an enclosed space. But because it's such a small molecule, the higher the pressure you put on the tank, well, the faster it's going to escape. So it's a catch-22. And that's one of the reasons why hydrogen isn't part of the economy right now. One of the reasons is it blows up. It's very volatile. But secondly, even though we can now use it safely in fuel cells, storing it is bitch. Like you can put your car on your driveway and then, well, assuming it's not a fuel cell, assuming it was just a tank. But if you let it wait there for a week, you're going to find out you're going to have half the range left than when you parked it a week before. That's just not doable in the industry. You can't use that.
God.
So there's two ways around that. Either we find new ways of storing it, which is going to be a bitch simply because of elemental reasons, or we find a way to generate such an abundant amount of hydrogen that it's so cheap that it doesn't matter.
I gotcha. When in the meantime, you could just use uranium to run whatever the hydrogen-powered vehicle you could possibly, right? I mean, if it's an EV, well, uranium can power that battery, right? Instead of using a hydrogen fuel cell.
I think the future is going to be combined. I think we're not going to see just EV semis or EV this. It makes no sense to run a consumer car on hydrogen, because you're basically there with a battery. If we can manage, say, 75 miles range on an affordable price, that's going to serve your needs for 95% of all people. If you then bring out a model that doesn't just have a electric vehicle setup, but also has a hydrogen fuel cell battery, well, then it's simple. For daily use, you just charge the battery, and for long-term trips, you fill up the tank with hydrogen once, and maybe you lose 3% of it in a day, but you're only gone for a week and you refill it 4 times. That makes the most sense, because otherwise you have to drag 400, 500, 600 miles of range worth of batteries with you every single time you drive. Batteries have mass. It costs energy to move mass. The heavier the car is, the more energy it costs to move. If you start calculating the difference between moving A, just a bunch load of fucking batteries, or B, a much smaller battery pack with a small fuel cell and an attached hydrogen tank, which you fill up once in a while, I think we can bring both the range up and the weight down considerably. That would just be next generation hybrid tech. Only with the gas engine, you needed to have a drive shaft. So you would need Toyota with the Prius actually developed this. Some people think Tesla was first. No. Toyota made electric vehicles popular with the Prius because it just worked. But they actually had to develop a dual shaft crankshaft crankshaft for that, because one engine was electrical, the other engine was gas, and they weren't attached to the wheels. They were attached to a drive shaft. So they just needed to have 2 drive shafts. Very complex technology, but they worked with what they were given. However, as I understand it, fuel cells extract electricity from burning hydrogen, and it emits water. So if we can generate electricity in fuel cells, then it basically means that we have a whole different way of electricity generation that might be much faster, or might more compact, less weight, and we can just use those as electricity generators. And what kind of fuel does it take? Well, they take hydrogen, because they're hydrogen fuel cells. So you load them up with hydrogen once, you go on a long ass trip, you refuel 2 or 3 times, and the rest of the time you just don't use it because the battery will be enough.
Gotcha.
That's far more efficient. And if you just scale up the concept to semis, I don't think Tesla semi is going to be any success. I don't think any electrical semi truck is going to be a success, because again, it takes a lot of energy to move weight, and the Tesla semi might look nice going around a test track. I wonder what happens if you hang a trailer on it and see what happens to the range. I think it's getting fucking crater. So what I would expect to see more for semis is more towards hydrogen, because if we fix the storage solution, it's just easier. But where most of the power is lost or most of the energy is spent when you're talking about moving a weight is bringing it up to speed and slowing it down again. Now, with slowing it down, it's easy. You can use regenerative braking, and because it's a lot of weight, it's going to generate a lot of power. But you're never going to gain more than you had to use to speed up. However, electric engines have the trait over gas engines that they produce enormous amounts of torque. And if you want to pull something really easy, you got to use a lot of torque. So what I would expect the future of semis to look like is basically using a hybrid technology, just like the Prius, only a small battery to bring the truck up to speed with enormous torque so that the least amount of energy is wasted and it's most efficient. And then when it's up to speed, which doesn't cost that much energy, it switches to a hydrogen fuel cell, which just keeps it up to speed. And then whenever the truck has to slow down, they can use regenerative braking to recharge most of the battery. And you can calculate the difference and just recharge that with some fuel cell excess. And that seems to me the most efficient solution for an electric 18-wheeler.
All right. So you're bullish long-term the use of hydrogen in.
Yeah.
Okay. So where does oil fit into this energy mix in the future?
Simple. Oil is never going to run out. It's going to run low. So that's always what peak oil is about. It's not just going to disappear, but it's going to be more expensive. Now, I've said to you before, let's make it an update from the video that we made just before year's end. What were the best investment opportunities 2021? Yeah. I did mention oil, and I did say second half of 2021. Now, we've just been through the first half, and oil's gone up.
Yeah.
But I already posted on Twitter, I'm not gonna invest in oil, not in the first half, because it's ridiculous. The entirety of Europe just locked down for the entirety of the winter. I'm in the Netherlands. We're not going to get any relief until the 30th at least. And according to the radiation charts, case count isn't going to drop or start dropping until, say, the 26th, 28th, when there's a radiation spike and the spring will begin. And it's going to take 2 weeks to show up in the charts. So we're not going to get any lockdown relief until midway April in the Netherlands at the very least. I read Italy's back on lockdown. Everywhere else in Europe isn't going good. Spain never got out of lockdown. They've been on lockdown for months. Where's the oil demand can come from? Last year when this happened, we had only 2 months, let's say 4 months of lockdown from March, April, May, and some in June. That's all we had. Now we've had October, November, December, January, February, March, May, April, June. Most will be open by June. But some countries are fearful of cases will open slowly. So that's half a year. It's like, why is oil still above $60? I know inflation's affecting it, but there's still something like demand. And when recently there was a bigger than expected surge in crude stocks, it went from like $66 in a few days to $61. So it dropped 10% almost out of nowhere. But there's no reason. Like, oil will always be important, because energy is important, like uranium is important, and stuff's still gonna work. And we're gonna get a reopening soon. However, in that reopening, that demand is already priced into this price. This is not just inflation. Although I would say that this run-up since the start of February is suspicious, but then still, it just doesn't match the well. Everything since October is inflation, but there's just no reason for it to go up this fast, this quickly, this far.
Yeah, I think that's a very wise and measured approach to this, because you're right. Any sort of like winter 2021 lockdown or any sort of negative growth because of the lockdown will cause oil to crash, especially if inventories are rising again, right? Just like in 2020, March 2020, right? Remember how it crashed?
Yeah.
So
it's not just that, but if other events unfold, like the mortgage market or the housing market in America imminently collapsing, well, a lot of people are going to go broke. A lot of people can't afford cars. A lot of people can't afford to drive, and then no one's buying oil at the pump. That's a massive demand shock, and oil is going to crash. Now, in response to this, they will print a shit ton of money, and we're going to get hyperinflation for sure. It's just a question of when, not if. However, this, what we're just describing, is a sequence of events. And that's another thing I try to make clear to people. You have to keep order of operations in mind. If you get the order of operations wrong, you're still going to lose a lot of money because you're going to invest in the first thing, in the wrong thing first, which is going to go down. And then you're going to miss out on the second thing going up. So it has to go down. It has to crash. I can't even name a price target because I'm still on my, I don't know, I've been saying it for like half a year now. Calling price in this market is folly. I have called the Dow Jones within 2 points accurately. I've called the VIX until the point accurately, to the decimal point accurately. And I am saying this market, don't call price. I feel for the technical traders. I really do. Their job right now is so fucking hard because technicals alone just won't save you. If you just look at the oil price chart over the last 2 years, not 1 year, but 2 years, so since January 2019, name me a technical that describes this. Go ahead, I'll wait.
Right. Yeah, it's all over the place.
So technicals are very useful in a calm market that is going in a direction. But when the winds change, technicals are useless. So you have to keep that sort of shit in mind. And for oil right now, it's got to go down. If I were to guess, I would say $40.
Yeah.
Just pulling that out of my ass again. I definitely do not think we will see another negative oil price. That was a once in a lifetime event, and everyone who was there, I hope you enjoyed it because we are never going to see that again.
Right. So as a long-term investment, you are still bullish, like you had said in December of 20, right?
Yeah, I'm still sticking to the plan. I mean, We just talked about how silver's collapsing, how there's defaults now, how there's silver that's unobtainable now. It might very well be that in, like I said, the second quarter of 2021, I will rotate some of my exploded silver winnings into oil. After the demand has crashed and people just start using up whatever supply we pumped. And the best news for oil here is that even when there's a massive slump in demand, I thought global oil demand in 2020, like the first and second quarter, like the worst of it, dropped by something like 25%, which is absolutely mind-blowing, but it also tells you that the absolute floor for an insane calamity like this is 75% of current use. We're just not going to go lower than that. Not until there's a protracted downturn in which I don't have to tell you that shit's going to go down. You will be screaming at your friends that shit's going to go down, and they'll be screaming at you that shit is going down.
Right. Looking at hard assets to protect your money in and to, take advantage of inflation trade. You go through all the commodities, and I've recently become a caffeine addict. So coffee and tea, like that captured my attention because I'm like, wow, you can buy a pound of coffee for $1.29, and it's like the most addictive substance in the world. So as a commodity, as a trade, like, what do you think of that? Are there opportunities there for investors?
Well, I recently became interested in coffee because not just because of hyperinflation, but because of the economic situation during hyperinflation. See, I like to divest. I don't like to diversify. Like, I don't think I should buy 15% tech because I already have 15% in metals. That's just throwing money away. But I do think in divestments, meaning looking for the reason one of your assets is a surefire thing going up, and extrapolating that reason to other sectors. Now, in the case of silver, which we just discussed, it's clearly going to go up because of financial and economic calamity. Hyperinflation, mass defaults, all of that happens in an economic depression. So we can glean from that we're heading towards an economic depression. Now, people don't remember, but they've heard of 1929 and the following Great Depression. And they think, well, every single company is going to go to zero. Well, that's just not how it works. There were many companies that went up tremendously throughout the entire Great Depression, most notably a radio company, because before World War II, radio was what YouTube is today. After World War II, it became TVs. Even though TVs were available before World War II, they weren't mass-produced or unaffordable for the masses until after. So radio was the thing. And since people didn't really have a lot of entertainment during the Great Depression, because a lot of entertainment had become unaffordable, something like radio did very well because it's an initial purchase, and after that it just runs on electricity, which you already have to use. But you still, whatever is on the radio, since you can basically see it as the first form of digital media or digital streaming, if you will, it can be changed whatever. Like, you can switch the radio to your favorite program if there's something on there which you don't like. If you don't like iron, it's just you can't really replace that in industry. So the way I look at that situation in the 30s and radio doing well, I basically see it as a creature comfort. Like, if our current world were to collapse, financially speaking, a lot of people will just simply not be able to afford a lot of the entertainment coming out now. Streaming services will seriously have to cut their prices or consolidate, for instance, because people simply won't be able to afford 5-6 streaming subscriptions. But at the same time, they still need entertainment, and like radio was in the 30s, streaming to a computer or to a device gives you a whole range of entertainment that you can select and you can continually consume without costing you additional costs. So if you have one streaming subscription on the streaming service that suits you the most, that takes care of your entertainment needs for like $5 a month, inflation adjusted. That's a very good deal. So people will take that deal over something like a new car, because that's a total luxury in an economic depression. If you have something that moves on gas or electricity, you're good. You're good. If it doesn't fall completely fucking apart, you're good, because there's just no more money. Now, coffee and tea, by the way, but we'll be talking about coffee mostly, fill the same sort of niche. Right now, when you say coffee, everyone thinks Starbucks. But Starbucks is horribly overpriced. It's bad coffee, and most of it's not even coffee anyway. Most of it's sugar. So that's going to collapse as well. When people are going to have to turn over every dime twice, they're very quickly going to find out that Starbucks is a complete excessive thing they don't really need, but they just need caffeine and sugar. But buying a bag of sugar will be cheaper than Starbucks, that's for sure. So what are they going to do? Well, they're going to return to basics. They're going to find a brand of good quality coffee that they like, possibly with an addition that helps them clear stress or keep their mind going for just a horrible, horrible period of time. Because I've often said that many people starve, and they will, but everyone who doesn't starve and makes enough ends meet to basically survive is still going to work very hard for very little pay. That's going to have psychological effects. And I can already tell you something like tobacco use is going to go up. People often ask themselves, why do the poor smoke? Why do the people who have the least amount of money continue to smoke, even if we artificially inflate the prices of tobacco to try and make them stop smoking? Well, as someone who comes from the bottom and has a lot of psychological problems, I can tell you why. Because I need to escape this motherfucking world.
Right.
Just for a few fucking seconds. No, it's not that bad, obviously, but many people are going to hear that voice in their head, and if they don't do something to stop it, it's going to take over their minds. And something like a simple cup of joe can keep you going through all the stress and pain, because you are going to have a shit day under a shit boss for a shit pay, and you're going to walk into a supermarket and you're going to pick up some fresh cold brew, which is very cheap because, coffee companies are going to have trouble too, but they still will make money. Prices in general are just going to drop, adjusted for inflation. And either you're going to sit at a bar or you're going to sit in your car on the way home because you got a nagging wife who also goes through a lot of shit. And you're just going to take a minute. And you're just going to have that little bit of caffeine, and that cup of joe is going to be there for you when nothing else will be there for you. They may not have the revenues they have now, but they certainly will have more revenues than any other company. And since wealth is relative, that just means that the coffee companies will do better than other companies. And that is how you get rich. You just invest something that does better than everything else. Either it goes up faster or it goes down slower.
Yeah, and their inventory is a hard asset, right? The coffee commodity. So
not as much as you would think. It's not a non-deprecating asset. Gold is so popular because it's a non-deprecating asset. You can stick it in the ground, you can stick it in the vault, you can stick it anywhere you want, and it's going to come out just about exactly the same in 1,000 years. So you can't stick an iron bar in a vault or in a pool or in a pond because it'll rust and it'll be worthless. So coffee is consumable and it's degradable. Coffee does have a shelf life, so it's not a store of value. However, it's something that is a drug in some sense, a light drug, but still a drug. It's an addictive substance. And as I just described, for many people at the bottom, it's the only form of escape they have, which is any sort of remotely healthy. Because if there's a gradation to how bad you get psychologically and how much you need to escape. I'm a well-known weed smoker. I smoke a ton of weed, but because I also have a very traumatized past, I just need more than a caffeine shot to get me through the day, because I have bad thoughts and I just don't want to have them. Now, like I said, most people will be normal. They'll be stressed, but they'll be normal stressed. So they basically need some sort of normal relief, and that's going to be either a high sugar drink or a high caffeine drink, or just tobacco, because tobacco is drugs too. Look, first time I smoked tobacco on its own without weed, I got high. It's the same feeling as hashish, only it just lasts like 5 minutes instead of 1.5 hours. It knocks you out. So smokers are drugs users, that's for sure. But that's already damaging to health, and caffeine isn't actually damaging to health. You can have a caffeine overdose, but you still have to be pretty fucked up to get that far. So in that sense, I still think coffee and tea as creature comforts in a depression will do very well. And even though there will be coffee companies that will go bankrupt, there's no replacing good management. If it's good management, then they'll pull through in a depression. If it's good management, they'll be the last one standing. If everyone's worse management, it's that simple. Like Peter Lynch says, stocks aren't lottery tickets. There's a method to the madness. You need to do your due diligence. You need to read a fucking quarterly. But if you do, and you can put two and two together, it's not really that hard.
Yeah. So how are you investing in the coffee space?
Well, I heard that your viewers like it when I talk about specific things, specific stocks and such. And I actually looked into a company not too long ago, which I thought was going to do well. And they actually came out with 3 months ending results just a few days ago, which are some blowout results. So it's definitely a good buy. So that's why I wanted to talk about it today. The company is JVA, or Coffee Holding Company. Now, it's not a coffee miner or commodity miner, but that means they do have a less good exposure to the price. However, you can quote unquote mine or farm as much coffee if you want, if you have no way of bringing it to people or turning it into a drinkable product. Well, the bean market will do good, but that's only one market, and not everyone's going to have nothing at all. So I went looking for companies that are basically expanding. Basically, the Warren Buffett model. He talks a lot about, I thought Sears Candy, which is a basic candy company that's done very well for him for a very long time because it's cash flow rich and people like candy. Candy's another creature comfort that will do well. Peter Lynch did very well with Dunkin' Donuts. He says, well, I understand Dunkin' Donuts. People love donuts and people will continue to eat donuts. So there were a lot of locations that Dunkin' Donuts could expand to, which they hadn't yet. So he invested in it. Dunkin' Donuts expanded. People in other locations apparently also love donuts. Go figure. So they just grew. Now, coffee's the same thing. Of course, there's already companies in the coffee market. But here's the thing. Every single company, especially big ones, have all made the same mistake. They are sighing under debt. Like the entire market is just filled with debt and leverage everywhere. So I thought, why not try to see if in a list of coffee company stocks, there isn't a junior. And when I looked for a list of coffee company stocks, there were apparently very little. It's a very consolidated market, which also means that if only one of them blows up, there's a lot of room for expansion. And of course, maybe if they make a superior product, maybe they can take over the market anyway. Anyway, I do start with price to inform me for performance, because it does mean something. But more than, again, how much money I could put in it, the other coffee company I came across was like $200 a share or something. I can't afford that. $5 a share I can do. But I need to see what the price action was from recently. And in the last 5 years, well, it dropped off a cliff in 2020, but it's been on a tear since. It recovered to before the crash, about the the end of last year, and it jumped recently. I don't know exactly why it jumped, maybe on end year results, but it's they were good. Like, they're doing a good job. And from their quarterlies, which we'll go through, they should go up much further in the second half of this year. You can see it's a small company, 30 million market cap, even with the increased share price at the moment. So there's plenty of growth potential here. Now, before we go into the quarterlies, which are the best source of information still, I do like to go through financials to see if it meets my standards for undervalue. So it has 82 employees, which, I like to see a good amount of employees in any company, which means that they can make payroll. And founded in 1971, also good, a longer term company that's been around for a while. So that means they're established. They know their business. They have business experience, even if they went up and down, and they are now poised to go up again. There's 11%, almost 12% held by insiders, which is a good sign. If insiders hold a lot, then they have faith. But there's still plenty of float left. There's not that much shares, 5.71 million. So they never diluted much, and there's plenty of room for the price to run away if there's enough demand for the shares. Now, market cap versus enterprise value is one of my favorite ways or one of the ways in which I try to find undervalue. And if the enterprise value is higher than the market cap, that's a good sign. Price to book is 1.07 currently. These values will change with time, by the way. So I'm just reading them. They will change by the time the videos come out. But 1.07 is very good when you consider there's even the silver miners and gold majors, which are known and have an established reputation. They are already trading at 3 or 5 times book value per share. Or no, price to book, I mean. So this is undervalued, so simply put. The PE ratio is high, but that's also price to earnings. And we've just gone through a shutdown in the entire restaurant industry. So looking at any coffee stocks or any stocks that serves the restaurant industry, I am already expecting a hit sales, and a pretty significant one. Who wouldn't? But that doesn't mean that the economy will never reopen. In fact, we can basically all agree on that we can never have a third lockdown, or not a third lockdown winter. Even if cases rise next winter, we have to keep the economy open because we just cannot take another hit like this. So, and with the summer coming and the sun will reduce cases, it won't make the virus go away, but it will, like last time, reduce the cases to a minimum. And people just need to generate revenue right now. So their earnings will go up when everything else opens again. It's more of a question of will they survive until it happens? And, well, that's a question of debt. So if I look at debt here, it's listed at 10.8% or 10.9% of equity. Their total cash is 2.7 million. Their total debt is 3.11 million. Which is very manageable considering every other company out there. 2/3 of it's short-term debt, which you can see, which basically is COVID. Like they had to draw on credit. Everyone had to. That's not a problem. In this case, it's more important to note that they have a free cash flow of 7.37 million. Now, I don't know how up-to-date that number is, but the last time they had an up-to-date number, it was still a positive free cash flow. This more than you could say for a lot of mining juniors. So their revenue did go down, but we'll get to that in a moment. Basically, their basic stats look good. That is what I look at. Also on stream, if you want to see me do this for a company that you like or you're interested in, you can just ask me a question on Twitch when I'm live, and I'll just do live research just like this. In any case, in this case, with the annual reports, on Seeking Alpha, so it's a bit outdated. You can see that the revenues dropped, but before they dropped, in this case, it's interesting to note that they were increasing. So they did go down that year from 2018 to 2019, but from 2017, they're still up significantly. Their operating income or earnings from continuing operations was positive, so they were making a profit until COVID. But you can see in their last report, which is different from this one, they are already making a profit again, and considerably more than in 2017 and 2019. That's not too bad. And we'll get to that in the full share reports earlier. But here I wanted to come to something which is a very good sign for a company that's undervalued, and that is that the diluted weighted average shares outstanding, so the complete amount of shares outstanding in the float, since 2016 went down. It went down from 6.1 million to 5.7 million in 2018 to 5.6 million in 2019. And even though the COVID crisis happened, they didn't dilute. And in their last EPS report, they're actually turning a profit again, considerable profit. better than their 2018 EPS report. So that is a sign of faith. They are buying back their own shares because they know the company is undervalued and they want to get more out of it. Now, the share price did go down since then, but I would think that if they didn't have to lend that much for COVID, they would have bought back more shares. If I was in charge of this company, I would have bought back more shares. So their financials look good at first sight. Their overview looks good. And I have a favorite measure for me to find undervalue, which is book value per share. Now, this divides the book value of the company by the amount of shares outstanding. And it basically says, well, if you were to sell the entire company now and you get the entire 100% of what it's worth and you give that to the shareholders and you divide it per share, how much do the shareholders get in dollar value? If this book value per share is lower than the current market price, then it basically says, look, if you sell everything that's on the books right now and you give all the money to the shareholders, you're actually going to turn a profit. Like, if you buy the company and you liquidate it, you're going to turn a profit. Now, no one's going to do that because that would be idiocy. But it is one way of showing this is severely undervalued because this is a discrepancy. This shouldn't happen. Now, in this case, the book value per share is $4 per share, which is substantial. And the share price is 5.15, so it's a little bit over. But the companies I like to invest in basically go, if the book value per share is higher than the share price, I will throw money at it almost sight unseen. I always look through the quarterlies anyway, but I already decide I'm going to put money in this unless I find something that sways me otherwise. If the book value per share is more than half of the share price, so the share price is less than double of the book value per share, I will immediately look at a company and start reading quarterlies because it's worth my attention. If it's above that, I will consider if there's external factors. If there's not, I'm going to find a company with a book value per share that's lower. So in this case, it's higher, but I do want to remind people that it jumped in the beginning of January, probably on end year results, and before that it was below 4. So it was actually recently still when I first found it had a book value per share lower or higher than the share price. So now with that established, that I think this company is clearly undervalued. There's also almost no short interest, by the way. By the way, I rarely look at PE because price is part of PE. I know price basically pretty soon is meaningless. So if it's under sector median, I will consider it a positive. But if it's not, I don't care. So after looking at the financials, I always read quarterlies and anything I'm interested in because, as Warren Buffett says, it is still true to this very day. The best source of information on any company isn't YouTube, isn't an analyst, isn't the advertisements in the newspaper. It's just the quarterlies they put out. Even if they're trying to hide something, even if they're not saying something you know they should say, that is an answer. Ignoring something or not saying something or avoiding the question, all of those are answers. You don't need a yes or no. So let's go to the quarterlies of this company, and I want to go through 3 specific things of this company that'll show you that it is indeed undervalued and it's not the statistics that are wrong. So this is the company website. I just wanted to show it. I think I've got no, it's light. Whatever. If the site's not completely good or hard to read, well, I've seen mining companies with horrible websites. That doesn't scare me. So the 2 things I want to show first is their year-end results, which they reported in February, apparently. So I have no idea what the price went up in January. Maybe it's the market bubble, whatever. Who cares? And there's some important information in here. So first off, this will tell you how they fared through 2020. They had a net loss per share over the entire year. And I'm just going to, well, I would say I would ignore this because it was a bad year for everyone. But it seems to me that $95,000 is low. If it's a $30 million market cap company with a 4.5 million free cash flow, 95,000 isn't much. That's 0.2. It's 2 cents per share, but their share price never went below $2.30. So that's not that much over a very bad year. They will tell you why it was down. So the decrease in net income was due to numerous factors which had to deal with the company's fourth quarter. For example, the fiscal year ended in October 31st, 2020, and the company had a loss before its non-controlling interest in its subsidiary of 336,000 versus net income of 265,000 the fiscal year ended before. So they have a subsidiary which dropped $500,000 in basically revenue or something like that. So that's considerable. So since they have a controlling or non-controlling interest, it basically gets added on their balance sheet, and it made things worse. So here it is. Well, in the quarterlies, I'll often state the reason for why, because you can't just tell your shareholders, well, shit hit the fan and bad luck. No, you have to give a reason, because these people put a lot of money into you, and they get very nervous if you don't tell them things. So the company consolidated subsidiary, in which it has 60% interest, had write-downs in both inventories and accounts receivable due to COVID-19, including approximately 85,000 write-down on receivables and approximately 217,000 write-down of inventories. So this is why I was able to answer your question as a negative earlier as to, is coffee a store of value? No. It leads to write-downs if you can't sell it. Simple as that. Now, continuing. Net sales. Their sales decreased by 12 out of 74.3 million. That is a decrease of 12 million or 14% from the 86.4 million that used to be. So again, if they have a net loss of 95,000 on net sales of nearly 75 million, it's absolutely nothing. That's a really good result for last year, considering they sell coffee and a lot of restaurants were closed. A lot of bars were closed. So they also list why the decrease in net sales were due to COVID-19 pandemic, which caused many of the company's green coffee customers who service the restaurant and food service industries, as well as the company's customers in the food industry space, to either close or suspend their business operations during the period resulting lost revenues. Now, I should note that people would probably think this is a problem because those shops are not going to come back when everything reopens, and it's going to be a shock to the system. That is true, but only if you are invested in real estate or retailers, because a lot of the retailers who sell the end product on their shelves are going to go bust. If you are invested in the commercial retail or mortgage market, well, you're screwed. But the supplier who delivers to those shops doesn't really care which shops he supplies to. If you can just push your product to another shop, or another shop expands into the bankrupt shops because there's now a gap in the market in that location and in business location, you're just going to be able to sell your coffee to the new company. Prices I have read, I don't know if it was in, here it is, in the cost of sales, which I'll get to in a moment. The price of coffee went up and it affected them negatively. So well, yes?
Well, yeah, I'm just saying, so will they be able to protect against that inflation rise in the price of coffee?
Yes, because I was just commenting that. In the cost of sales, it says here that the cost of sales for the fiscal year was 82.4% compared to 81.8% to the year before. Again, pandemic, I would expect it to go up. But cost of sales consists primarily of the cost of green coffee and packaging materials and realized and unrealized gains or losses on hedging activity. The decrease in cost of sales was due to the company's decreased sales and the rising cost of coffee. So the decrease in cost of sales, the decrease in how much it cost to sell their coffee products was due to the decreased sales, because if you don't have to sell something, you don't have to package something, so you don't have to buy packaging, but also the rising cost of coffee. Because if they get, if you have a 2% margin, that's a tiny, tiny margin, but 2% on $10 is a lot more than 2% on $1.
Gotcha. Yeah.
That's it. They're a middleman. If their coffee growers quote them a higher price, they have no choice but to quote the shops a higher price. Now, if the shops go bust because the people in the neighborhood can't afford coffee, that's a shame, but that's not going to affect the wholesaler. He's just going to relocate his product. But that is also something to keep in mind. Wholesalers who cannot do that, who do not anticipate these kind of problems, especially in or after a bad year, they're going to fail. If there was a coffee company out there who sat on their hands throughout the entirety of 2020 on the decreased sales, on decreased revenue, and basically said, well, we know the government is printing money, so inflation will take care of it for us. No, you can't live like this. Inflation, again, or hyperinflation especially, is such a bitch. It affects everything, everyone. And it's not like you can't survive. It will just become harder to survive. You need to think for yourself. You need to look deeper into things. You can't rely on price. So if I can do that and I run a business, well, then the business can do that. So if other business management people can do that, well, then there's no problem. I will invest in that business right away. So to go through with the quarterlies, this one is longer because it's a year end result. But it's still important because it tells you important things, such as the rising cost of coffee decreases their cost in sales. And that is something you need to keep in mind going forward. So gross profit, it was also a decrease from the year earlier, resulted in, again, the pandemic, lost customers, outdated inventory, everything we've read so far. So that is fine. Here's where it becomes interesting. Operating expenses. The total operating expenses decreased by $1.3 million to 13.9 for the current fiscal year, from 15.2 the fiscal year ending the year before. So their operating expenses went down significantly. Selling and administrative expenses decreased by 8%. We can assume that is partly due to basically less product to sell, but that can't be completely it. Now, we can see here why, because they explain. The company's efforts to control costs through the elimination of redundancy in its operations and the elimination of certain unnecessary variable costs were the primary reason for this decrease. And here you actually have a quote by, I think, some explanation by the CEO, which actually tells you more about what they've done and how it's gone, what's going on. But the fact that this went down significantly is very interesting. So this stuff you just have to read. I'll read it for you. In a year where most people would choose to forget, we too were not immune to the effects of extended lockdowns and consumer belt tightening due to the pandemic caused by COVID-19. Our sales declined by approximately 12 million or 14% as shutdowns closed bars, restaurants, and most non-essential retail establishments. However, the decline in sales were isolated in two areas, while the balance of our business remained relatively strong in what proved to be a very negative business environment for most companies. The first area of our business that was negatively impacted by the shutdowns was the sales of green and roasted coffee beans to our small and medium-sized roaster clientele. Sales of green coffee to these roasters, who service the retail and food service industries, declined by approximately 5.9 million as business remained closed for multiple months throughout the fiscal year, as expected. The second area of our business negatively impacted by the shutdowns was our Steep and Brew subsidiary, which experienced a decline of approximately 4.5 million. Well, this was the big write-down we saw earlier. This decline was primarily due to Steep and Brew's largest customer converting its existing relationship from a direct customer buying basis to a brokerage basis. Thus, we were unable to recognize 100% of the revenues as we have done in the past, stated Andrew Gordon, Chief Executive Officer of Coffee Holding. So there you have it. What the write-down or the decrease in revenue was from their subsidiary first having a direct contract with a supplier, and that moved to a bidding process. So they were unable to get the premium that a direct contract commands, and they now had to basically reduce their margins, as it comes down to. It's a negative news, but bad stuff happens in business. So let's read on. We had a similar net loss as in the prior year, as we lost approximately 95,000 or 2 cents per share. However, considering that our revenues were lower by approximately 12 million and our gross profit and operating margins remained relatively steady, we believe that if the revenues of green coffee sales were not negatively impacted by the pandemic, we would have been profitable in the year, as this area of our business has historically experienced margins between 15 and 22%. And is highly scalable with minimal variable costs needed to increase sales. Now, that is music to my ears. Those are some sweet margins and easy to scale. That is reopening goodness. So, if the customers come back and if not other companies take their place, they will easily scale up to increase sales again, which is good. In addition, other one-time or non-cash items which negatively affected our bottom line, including a non-cash cost of approximately 0.9 million for our stock option plan, approximately 0.7 million in depreciation and amortization, and approximately 0.2 million in interest expenses, which offset our income from revenues. Other factors negatively impacting income were approximately 85,000 write-down of receivables and approximately 270,000 write-down of inventory, which we talked about. We believe these year-end write-downs, which were greater than past years, were due to the impact of the pandemic caused by COVID-19, which slowed sales to existing customers, causing inventory to become outdated, in addition to forcing many of our smaller customers to permanently close their doors. All of these factors negatively impacted our ability to turn inventories at historical and forecasted levels. So I would agree with them. I would agree that it really is the cause of the pandemic and the massive shutdowns, which were historic, and we've never shut down a planet before. America's never kept their economy completely closed for that long, so I give them a little leeway. Despite the significant headwinds we endured during this turbulent year, I believe our company successfully navigated the COVID-19 economy and did the work necessary to position our company and business for future success. Although most supermarket chains and customers were curtailing operations, delaying category reviews, and postponing purchases of new items, we were able to expand sales of Café Caribe or whatever it is, in new and existing markets, including sales to the United States military commissaries. We also added a new 150-store supermarket chain in Florida, to which we plan on commencing shipping product in the second fiscal quarter of 2021. Florida is doing very well because of their reopening and keeping everything open strategy. So there's plenty of money in Florida. And they are right. A lot of people had to cut back, but they didn't. They expanded. Now, I told you before, Elliot, that I already read this and I didn't want to say anything because I genuinely wanted your reaction to this. So what do you think?
It sounds like a good growth story. Absolutely. I mean, they're expanding military commissaries. You got to love the government contracts, right?
Right. I love government contracts.
Yeah, and Florida is a great state. I mean, they're booming, unlike a lot of others. So there you go.
Yeah. And it's not even that. We also increased sales of our S&W coffee brand to a major wholesaler in the Midwest. And we were awarded the private label coffee business for 2 major supermarket chains, also beginning shipping in 2021. Beginning shipping. Lastly, in October 2020, we acquired a 49% stake in the Your Day Well LLC, a hemp and cannabidiol CBD beverage company based in Columbus, Ohio. The Your Day Well is a functional brand incubator focused on creating innovative and sustainably sourced CBD-infused beverages for health and wellness-conscious consumers. Now, I'll just stop there for a minute because I've been talking to a guy via Discord with a business plan, and I have been confirming that CBD is just flying off the shelves right now. It's almost impossible to just grow the stuff fast enough. It's really a hot item. And then they say, our plan is to begin infusing our brands, Cafe Caribe Latino Espresso and Harmony Bay Gourmet Coffee, with CBD as soon as we are comfortable with our formulations. We believe CBD coffee will be a fast-growing and profitable market for us, and if the legislative environment surrounding CBD products continues to improve, which it has and probably will, our plan is to offer all our customers the opportunity to infuse their products with CBD. I remain confident that our business is extraordinarily resilient, and despite a year that proved to be unpredictable and challenging, we still had many successes which we believe will lead to our positive results for our company and shareholders as early as the first quarter of 2021 and beyond. And the rest is just about the company. So what do you think, Elliot?
I think there's real organic growth. I think it's a nano cap stock. I mean, imagine if you can get this for like a $20 million market cap, there's like a market correction. That's like the price of an expensive house in California. So
again, I would advise people when looking at stocks like this, forget pennies, forget cents. If it's going to go to $500 a share, you're not going to care if you're going to buy it at 510 or 520 or 550.
That's true.
Just if you really want to average in, or you're expecting a crash, like we're actually expecting a crash, then put some money in now, but not everything. And if it drops, put some money in more, put some money in more, put some money in more. Yeah. If you know a valuable company like this will do very well in the future because they're beginning shipping in 2021. We're 2.5 months in. So that's good. But the sales don't immediately start. People need to find the brand. People need to discover the company. So that hasn't really impacted. It should have impacted the first quarter. And excuse me. As we'll see pretty soon, it has. But the other part was in the second fiscal of 2021. That's just starting. That literally started for them a few days ago. And the second fiscal is for the CBD stuff. That's also not started yet. That's also second half of this year's second fiscal quarter. So as soon as this start, the price is going to go up. So should a crash not happen before they start putting out some really, really good results, you want to have some money in already. Like, you don't want to miss out.
Yeah.
Perfect.
Quick 3x to 100 million. If it can get to $1 billion market cap, that's like ridiculous returns. So, yeah, and it's in a great space. So, yeah.
And we're not even done because, first off, it's very important to read the quarterlies, but people think they read one quarterlies and they're done. No. The real way to discover value and to avoid looking at price is to track performance through time. You don't need a lot of data points. You just need to see, is this moving in the right direction or is this moving in the wrong direction? Now, as on the 17th of March, they published their 3 months result ending in January 31st, 2020, which is the follow-up to this thing, is the next quarter. We can get a good sense of, how have their projections worked out in the time between this quarterly and the next one. And if we just draw that line onwards, we can think about how are they doing in the second half and how are they doing in the third half or the next year. once this shipping is all started and the CBD stuff is started. Well, for that, we go to this one. Reports results for 3 months ended January 31st, 2021. Sorry, fire truck.
I love the European sirens. It's so different. It's great.
Yeah, but just to continue, I will basically read this whole thing because it's a lot shorter. Operating results. Net sales. Net sales totaled 18.1 million for 3 months ending January 31st, a decrease of 6% from the first 3 months ending January 31st, 2022. That's fine. The crash didn't happen until, say, February, March, let's say March last year. So we would expect their net sales compared to last year to have a completely blowout result in the next quarter, because then they're going to compare it to the bottom of a pandemic. And since they're doing well, it's always going to be a blowout result next quarter. So you can already look forward to that. Cost of sales. The cost of sales for 3 months ending January 31st was 13.6 million, or 75.3% of net sales, compared to 83.8% of net sales last time. So before the pandemic, the last quarter before the pandemic, the cost of sales was 83.8%. Now, thanks to their cost cutting measures and their expansion and everything, and their sound business management, they dropped it by 8.5%. That's significant. If you can drop your cost of sales by 8.5% in a year's time, that is quite good. That is a successful reorganization. So cost of sales consists primarily the cost of green coffee and packaging materials and realized unrealized gains in hedging activity. Yeah. The decrease in cost of sales was due to the company's decreased sales, partially offset by its favorable green coffee position and hedging. That's interesting. That's not because of reorganization. That's because of its favorable green coffee position. That means that what we just read in the previous quarterly, and that's so great, we don't have to wait 3 months to get the next information. We have to remember what was in the last one. No, we just read them back to back. This means that their branching out in green coffee positioning is working out, and they can pretty much scale up, or they are already scaling up. We don't know who they're selling to or how their supply chains go, so we can get little senses like this. But considering that it's already being partially offset by favorable green coffee position and hedging, if the coffee price goes up further, this is only going to work more and more and more in their favor. And that is what I like to see. I like to find a snowball which is small and compact as fuck, because I will just roll it around the snow a little more, pack it a little more slow, pack it a little more, compress it till it's nice and tight, roll it right up to the edge of the mountain. Will cost a lot of effort, and then just tip it over. Because it's so compact, it won't blow up, and because it's so heavy, it'll just keep rolling, picking up snow. So if something happens to push the snowball over, it's just going to keep picking up snow. It's not going to fall apart. And little sentences like this tell you something like that. Gross profit for the 3 months ending January 31st amounted to 4.47 million, almost 4.5. 24.7% of net sales compared to 16.2% of net sales. So gross profit is even better. Operating expenses. Total operating expenses decreased by 361,000 to 3.3 million for 3 months ending January 31st, compared to 3.6 million previously. That's a 10% drop. Selling and administrative expenses decreased by 344,000, and officers' salaries decreased by 17,000. They're actually reducing the pay of upper management. Son of a bitch. I didn't think I would see that in 2021. Yeah. The company's efforts to control costs through the elimination of redundancy of its operations and the elimination of certain unnecessary variable costs were the primary reasons for this decrease. These efforts were partially offset by stock compensation expense of $190,000 and the increase in the company's freight costs as it increased and expanded its product distribution. So they had a previous stock compensation plan in place, which they are still obligated to pay off. And they actually removed management positions. They didn't cut staff, they cut management. I read about it in some other document. I think I went back in time further. Maybe it was another company. But in any case, it says right here that their officer salaries decreased. So they're taking senior management pay cuts to improve their financial situation. And that just means that they have faith in this company because they're taking a pay cut now because they know they can just get more pay later when their shares go up.
Yeah.
That's why they're taking a pay cut. That has to be. So if we just go further, net income, the company had a net income of $677,000 or 12 cents per share, basic and diluted for the first 3 months ending January. They had a 12 cents per share income in the middle of fucking lockdown number 2 as a coffee company, compared to a net loss of $600,000 for the 3 months ending January 31, 20. This is a fucking blowout result for a company like this. It's a $29 million market cap company.
Exactly.
I even want to calculate it. Let's just do 29 million round, and we divide that by 677,000 round. That's 42 times. Well, divided by 42. That's 3% that's 2.3% of market cap profit.
Wow.
Net income. Their net income is just 2.3% of the market cap in 1 quarter.
It's not being valued like all the other bubble tech stocks, that's for sure.
No, and that's compared to a net loss the year before. So let's see what the CEO had to say. We are pleased to begin the new fiscal year by reporting a big improvement in our operating results, I'll say, stated Andrew Gordon, Chief Executive Officer. With last quarter's inventory write-downs from our Generations / Steep and Brew subsidiary behind us, we were able to earn net income of $677,000 or 12 cents a share, as our profit margins improved substantially compared to last quarter, I'll say. Adjusted EBITDA was $1.4 million in the current quarter, with the price of green coffee at 3-year highs, and that's going to go up further. We are no longer experiencing the downward pricing pressure of the previous 3 years, which saw coffee prices languish below $1 a pound for extended periods of time. Well, there you have it. You wanted to know, are they protected from the price of inflation? Protected? They benefit from it. They're just going to charge the cost onwards to whatever the fuck store they sell to. And if the one company one country runs out of stores they can sell, then you can then always expand to a next company. This is a micro cap. Like, this is like investing in Walmart at the IPO, because they don't have that many stores. They don't have that many stores they're shipping product to now, but they are increasing rapidly. And they are now establishing presence in Florida, which apparently they either didn't have or not that much, because you don't expand to somewhere you're already at. They are expanding to the Midwest. Basically, they're building up a Midwest presence now, and everyone's moving to Texas. Well, so I can't see any bad stuff in here. Yeah. Those low commodity prices had a negative impact on the margins of our sales of green and roasted beans, as well as forcing us to discount prices of our private label and branded products to remain competitive in a low-priced national retail coffee environment. Basically, they're saying that they're coming out of a bear market. How much better do you want it? In addition, during the first quarter of 2021, we also reduced our operating expenses by approximately 10%, as our past efforts to control costs had a positive impact on our operations during the quarter. We also were able to absorb the stock option compensation expense of $190,000 incurred during this quarter. And with only 2 quarters of expenses remaining, we are 2/3 of the way home to eliminating this expense, which resulted from our previous grant of stock options under our options plan. Oh, good Lord! It's going to get even better in 2 quarters. This is a significant cost. It's just going to puff. So that 677,000 is going to be 860. Just if by nothing changing. It's just by nothing changing. Although sales decreased by approximately 6% compared to the first quarter last year, we believe that as businesses continue to reopen and the new customers we were able to attract over the last several months, we will begin to see a return of positive quarter-over-quarter revenue growth, I'll say. Lastly, we have nearly completed our initial testing of our CBD-infused single-serve cups and are hopeful that we will be able to begin offering these for sale to our customers during the second calendar quarter of 2021. And that's the last thing I wanted to show you, the website of their subsidiaries. So they have cold brew coming soon. Stay tuned as we prepare to launch the Stephen James curated cold brew coffee collection with hemp CBD. And this is their collection. They're coming soon.
Looks good.
Ground coffee. And they basically have a bunch more stuff that they are selling. That they are into tea too.
Now, with your marketing knowledge, what do you think of their designs?
I do think it's classy, but it's also it reminds me of Johnny Walker. Not the bottle, but the box the bottle comes into. It kind of looks the same.
Yeah, I like it.
But yeah, it's classy. It's probably going to be a premium product. CBD is hot right now, and I don't. We're heading towards depression, and if one cup of Joe does you well, why not add another drug to it that can't harm you? Because there's never been a death from marijuana in the entirety of medical history, not from THC, not from CBD. So
it would be interesting if they want to expand into the THC space and put that in the coffee. That'd be one interesting high.
If it works, look, if you're a habitual user, you won't get more than a quick rush from it if you don't put in too much.
Right.
And if they find a way to percentage it per drink, you can just take a strong drink when you're at home. You can take a light drink at work. Since you're an habitual user, it doesn't affect you that much. But it's, I can't see anything that I wouldn't like about this company. If you can, please tell me.
No, there's nothing I can't. I mean, I agree. It's a solid, nice, early stage, small company. So, I mean, I agree. I'm going to add it to my watch list. Check it out. You know, there's a bunch of other companies I'm looking at. I'll definitely monitor it, though.
I will say this. I haven't got any money into it now, but I'm also broke. But probably before this video will come out, I will put some money in. Or if I decide against that, maybe the silver market collapses and I just toss everything I have into a silver miner, then I'm probably going to rotate that money later into this company before the second half, or when I learn that their product is launching soon. Preferably not, because the market the price will spike on events like that, and I prefer to get in cheaper. So I am probably going to... if I have the money for it, because there's a bunch of companies I want to buy, I will average down. So I will put some money. I would put some money in now, so I know that I'm in. It will also allow me to track the performance more closely, because again, I don't look at price, but it does inform me. So if I know that hyperinflation hasn't affected prices that much yet, and this is still up a lot, well, I know it's doing well. Conversely, if it's not, I know it's doing poorly. But I will probably rotate into this before they launch their brands, because this is like finding Sears candy. at the moment of initial expansion. I don't know why they are still small time if they've been around so long. Maybe the previous owner was fine having a small business and the new owners want to expand. I don't know what the history of this company is. I do know that it's been around a long time, and the current fundamentals, really the fundamentals as pertains to value, they're all here.
There we go. Thank you for sharing that early stage asset with us. Appreciate it. So, we're both running on fumes. It's 1:30 a.m. PST right now, and it's like, what? You've been up since how long? I mean, we started at 6 a.m., right? So
I am now up 12 hours, 12 and a half hours. No, the 13 and a half hours.
Yeah, and we first started talking at 6 a.m. your time. So, like, I'm running on fumes. Do you have anything else you want to add to kind of bring this conversation to a close?
Not really that I haven't already said. I talk a lot, I know. But if people take anything away from this conversation, it's price is a unreliable narrator at this point. It will lie to you, it will cheat you, and you have to look deeper. If you cannot do that, if you literally cannot do that because you just don't have the capacity, that's not on you, that's just the way you are, that's fine. Buy GDX, buy SILJ, just buy a general ETF of half of the money in juniors, half of the money in majors. So GDX, GDXJ, SIL, and SILJ. They won't do as well as a select hand-picked basket of companies. Because for that, you have to go through the quarterlies like I did tonight with the coffee company. But if you are unwilling or unable to do that, buying a general ETF is fine. All right, so you won't get 50 times your money. You will still get 10 or 15 times your money. That's, for normal people, it's quite considerable.
Yeah.
Just don't be greedy. Don't. If you don't have the skills to be greedy, don't be greedy.
So yeah, we talked about where people can go to find you with your Twitch, but just for the new listeners, where can people go to learn more from you?
So basically a couple of places. First one is Twitter. If you want to catch me on the daily, I do basically Twitter research. Sometimes I post very long threads, sometimes short ones. If I see a world event happening, see something important, it'll be on my Twitter immediately. Second place is desogames.com, which is my website filled with articles on economics and a couple of things. Currently, I'm not writing many articles, but that's because I'm writing my books. These books do not have a release date yet, but at the rate I'm working at, it'll be months, not years. And there will be 3 books on the definition of money, value, and the crypto future. And finally, there's my Twitch, which I stream basically what I did tonight on video, how I analyzed, like I said earlier, coffee holding company. I do that on stream on Saturdays on my Twitch, which is twitch.tv/desogames. On Saturdays, it's sub chat. So people who subscribe to the channel, they give me $5 a month and they get to talk to me on the Saturdays. But I do other streams through the week as well, and I always open up the chat to everyone. And they just ask me questions. Hey, Deso, what do you think of the markets? And I say, well, this is what I think about the markets. What do you think about this company? I'll look into this company. If I don't know, I say I don't know. If I suspect, I say I suspect. And if I think this will be a good company, I say this will be a thing. I think it will be a good company. So there you go.